Ladies and gentlemen, a lot of people have written to me asking me, Mr. Lu, is it more meaningful to top up their special account all the way to the full retirement sum to maximize the interest gain in future, or is it a more wiser thing to space out their top up so that they can get the tax relief? Today, I'll give you an unequivocal answer, very clear and very precise answer. So let's watch until the end. So really, it's a question of why top up so quickly, everybody, and miss the tax relief that's given by IRAS. So, so really, interest compounded or tax relief, which one actually wins in the long run? So today I'll give you the answer. So why are people split? Now, fortunately, we have a good problem. In the past, people were actually very anti-CPF, especially 10 over years ago, where people are Hong Lim Park protesting, return my CPF, that kind of thing. Today, those voices have died down, okay? But today, right now, everybody is how to get more money out of the CPF. And today, there are many avenues that you can get some tax benefits from topping up CPF. And this is where, this opportunity has come up, which is the $8,000 annual tax relief if you do a retirement sum top up to your special account. Now, this is highly encouraged by many people, and this is where another voice have come out and say that no, you should top up your FRS to full first. Ignore the benefits of the tax relief that IRAS is giving you. So, which one is better? So, just to be very clear, top up give you tax savings yearly. So if you delay every 8,000, 8,000, 8,000, 8,000, 8,000, you can just go on this way. You will save you money from paying too much tax. But if you rush to top up, you will miss out a lot of tax savings in later years. But those early top up will give you exponential growth in your special account. So the question is, how much is the opportunity cost of waiting? So, what is the sacrifice that you are making by delaying? So today I'll give you the answer. So I'll give you two case study. Number one is a case study where there's a 10% marginal tax rate. Another case where there's a 20% marginal tax rate. I'll give two case study of one person that's 30 years old, one person that's 40 years old, and let's see what it means by that. So the underlying assumption, CPF Special Account gives you 4% return. The full retirement sum this year is $220,000. It went up by about 3.5%. That's great. The annual top up that you can get into your special account under the RSTU retirement sum top up scheme, 8,000 for tax benefit. And actually, there's another one which I'll ignore because that touches your parents or your grandparents or your parents-in-law. I'll ignore that. And I'll also ignore the inflation impact. And for simplicity, let's just start that your tax savings are fully consumed. It's not like very significant. So you're not reinvested and compare the outcome. So one is a lump sum top up to the full retirement sum. One is a delay top up, 8,000, 8,000, 8,000. So let's see the results. So age 30 years old, a long runway scenario. So this is a person that's 30 years old. His retirement age is 65 years old. He has a time horizon of 35 years. And he's going to adopt both strategy and see the difference. So in strategy one, he adopt a lump sum top up. So what he does is at age of 30, he doesn't have much SA. He started working. So he's going to whack $220,000 down. I didn't say $220,000 down at age 30 is realistic, but I'm just saying it's a hypothetical situation. And later we adjust it down to half at a 40 years old case. So 220,000 down, he compounds for 35 years. And as a result, and we also assume that he's not going to work anymore and has work contribution. So at $220,000 that deposited at 30 years into his special account, the interest gain will be $650,000. Okay, when he reaches 65 years old. His special account at that point in time will be $870,000 at 65 years old. That's a hell of money. Okay, a lot of people underestimated the power of 4% over a long period of time, and that's the secret of how many people got very rich through CPF. Now, the other approach that he is now contemplating is this approach: 8,000, 8,000, 8,000, 8,000 for 27 years. And finally, he hit his full retirement sum. And after that, no more contribution, just compounding. If he goes by this approach, okay, his special account would have $564. Wrong, $564,000. Okay, and he earns $344,000 at 65 years old. Now, this has yet to take account of his tax savings. So, how much will he have in his tax savings? Well, his tax savings is, if he has a 10% tax rate, will be $22,000. Okay, and if it's 20%, will be $44,000. Why? Because it's just 10% of it. 10% of $8,000, which is just $800. Okay, if it's 20%, will be 20% of $8,000, which is 1,006. So he forgoes a lot of interest in exchange for a little tax savings. So even if the tax rate increased to 40%, which doesn't exist in Singapore, let's say 40%, okay, his tax savings will be 88,000, which is still a huge gap from his huge interest gain that he would have. So we know that now 10, 20, 40% tax rate will not give him the kind of benefit that will flip the decision. So what will it take to flip the decision? What's the tax rate? Well, we calculated he needs to have a tax rate of 130%. Nobody will tax more than 100%. So basically, the maths are just simply do not favor a delay top up. So the power of compounding far outweigh all the tax savings that you can ever get. Now that's for 30 years old with a pretty extreme example of topping up everything at one go. A lot of people say, but Mr. Lu, I wouldn't have so much money. Let's use a more realistic case, okay, shall we? So this is now CPF strategy at 40 years old. So this person is now 40 years old. He has got another 25 years more to retirement. He doesn't have the full retirement sum, but he has got half of it in his special account, $110,000. So, and right now in his ordinary account or in his cash, he has got $110,000. Does it make sense for him to do a one-time top-up to shoot it up to the full retirement sum? So let's see how this compares to another case where he spaced out his top-up. So now he front load the special account. He load up $110,000 at age of 40 years old, and suddenly it shoots up to 220,000. He can't top up anymore, and from there it grows at 4%, 4%, 4% a year. My goodness, right? So at retirement, he will get $586,000. Okay, $586,000 at retirement. That's after 25 years of growth at a 4% guarantee rate. This is risk-free compounding. Well, the other approach he take is, well, he will contribute $8,000 every year to his special account. Okay, gradually earn some tax savings, a little bit at a time, a little bit at a time, a little bit at a time, and by doing this way, his interest growth is of course much lesser. And by the time he's 65 years old, these drips and drabs only gives him $469,000 as compared to previously $586,000. Now you might say, oh, now the gap is smaller. Maybe his tax savings will be a lot. Tax savings at the extreme, which is 20%, will only give him 20% times 8,000 times 25 years, which basically only give him $40,000. So $40,000 compared to the difference of right now $100,000, I think it still makes absolute sense to top up your special account as quick as early as possible. So in a nutshell, all this simple numerical example just basically shows that the power of compounding of the 4% interest, if you are to harness it as early as you can, will give you powerful outsized returns. And why do people get this wrong is because people tend to view tax relief as immediate gratification, cash at hand, where compounding take a long way to go. They don't see the money. So why do people have this dilemma when the when the answer is so clear. Number one, the mathematics is not so straightforward for a lot of people because a lot of people view that tax relief is like an immediate cash at hand, like a CDC voucher, SG60 voucher. You get it very quickly and get it at hand, where all the compounding interest is far, 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 far away. But they fail to see that the compounding interest go up at some astronomical level, and every year of delay is a permanent loss in future. So I want to stress that a lot of people fail to appreciate the power of compounding and chose the immediate savings, which is a pretty bad trade-off. Some people might say, isn't there a time value of money objection? Isn't money today in the pocket worth a lot more than money later? Well, it depends on the quantum. So just a short answer is that no. In this case, no, because the exponential growth is just a lot. Okay, just a lot. The difference is just way, way, way apart. And so I would suggest that everybody do your own sums and calculation based on your own numbers, but it's very clear this is very much better. There is one exception, which someone raised it to me. But Mr. Lu, I can beat that 4%. So I basically get the tax savings, whatever money which I would have put inside, I go and invest in S&P 500. I put it into NASDAQ. I go and put into crypto. I go and put in property. Whatever it is, right? I can beat that 4%. Well, this is what I have to say. Yes, on the top line, it is possible for some asset to beat 4%. But it is very difficult to beat 4% risk-free. No risk, okay? No volatility risk, no investment risk, and it's a very powerful financial safety net. And it's a precursor to a powerful, no worries, lifetime income, right? Where I actually teach people how to use this to generate 10, 15, $20,000, in my course, to actually generate this. This is the foundation of it. If you don't top up quickly, you have a huge struggle to get this huge sum of money later. The idea of having a huge pay that comes every month of my life, all the way from my retirement till I die, that is paid by the government, right? That is promised and paid by government. Wow, that kind of number is just enjoyable. I don't need to work a single day. I got no risk. I don't need to worry about tenants. I don't need to worry about stock market fluctuation. I don't need to worry about Donald Trump doing something stupid or the next president or Federal Reserve doing something crazy. I just enjoy this permanent stream of income. My only job is to quickly make sure I live healthy and live long so that this income will come in. Isn't it very wonderful, guys? So the prime choice is this. This tax relief that you get, yes, it gives you immediate cash flow, but compounding power optimize an insane amount of income for the future. So my suggestion is if you can afford it, okay, maximize your full retirement sum as early as possible. Right now, the full retirement sum has just gone up. Quickly go and take advantage of it for as early as you can. So these decades of risk-free compounding and in future retirement income will beat that few $1,000s of tax savings. Yeah, there's just no comparison. Okay, I'm happy to answer any questions. Just put your questions into the questions below in the YouTube chat, or else I could answer some of these questions in my live stream. Thank you for watching, and I'll see you in my live stream. Bye bye.